by Noel Morgan. He's a financial consultant, and Noel's going to tell us a little bit about the kind of things people need to be aware of when it comes to managing their money, and the kind of insurances that people could think about getting for their relationship to protect them from any eventuality in the future. Noel, first of all, you're very welcome.
Thank you.
Tell me a little bit about couples getting married, for example, or in long-term relationships. What should they be thinking about in terms of protecting their financial futures?
I suppose primarily starting off, there's obstacles in the way straight off from lack of conversation or lack of forethought before people get involved in a relationship, namely in the form of life cover, life insurance, and what to do in the event of a loss of income to either the main breadwinner or to a lower income, and the implications that actually causes then to the family unit and to the couple themselves.
Sure. And you mentioned life insurance. What is life insurance exactly?
Life insurance in its purest sense is an insurance that will cover the untimely death of a spouse or an individual. Sure. And it's designed to leave a lump sum for a loved one. That is life cover in its purest sense. It's become complicated and convoluted by the involvement of mortgages, secured personal loans, and with that being the mainstay of people nowadays looking at mortgages and looking at the amounts of money that they owe, it's moved away from the purest sense of what life cover should be.
Because in the past, my experience of life cover is that it's something that you're forced to get when you get a mortgage. Is that the way it still is?
There is legislation in place to state that when you take out a mortgage, you have to have life cover in place for the minimum of the mortgage balance and also for the term of the mortgage outstanding. Now, that is mandatory, but we would always advocate that someone should, at the worst case scenario, have life cover simply to cover a loved one and for expenses that remain should someone pass untimely.
And again, of course, the idea that our partner could die is something that no one wants to think about. And do you think that leaves people vulnerable to not having enough insurance at that point then?
People are certainly vulnerable from the point of view of thinking that life insurance is purely to cover a mortgage or a debt. Life cover should be put in place to certainly cover expenses relating to a funeral or simply to look after a spouse for a number of years after the passing, or to have an eye on the future relating to a family, perhaps as children. Would you like to maybe send your children to college, or certainly make sure that your remaining spouse is able to take time off work?
Right, so if somebody, God forbid, was to pass away, it's not to sound so negative, but if somebody was to pass away and only the mortgage is covered, then that person's kind of like financially vulnerable at that point as well, because there isn't enough cover to maybe provide for children to go to college, like you mentioned.
That's absolutely correct. You would certainly need to say, what would I like to leave for my remaining spouse and family in the event of my untimely death? Okay. A rule of thumb would suggest that you should take the higher income or the income of the person that is going to pass away and multiply that by the number of years you'd like your remaining spouse to be looked after. So, for example, if you're looking at someone who's earning an income of €30,000 and you want that income covering the spouse that's passing, you could look at €150,000 worth of life cover and say, well, that's going to cover my spouse for 5 years. That's a simple rule of thumb. But, for example, a 30-year-old man could get cover for maybe €14 per month, and that would cover him for up to €200,000.
It's not a lot of money.
It's not an awful lot of money at all. It works out usually about 50 cents per day, which, when you think of it in those sort of terms, is for absolutely nothing.
And do you think people are afraid of talking to someone like yourself in terms of looking at insurances? What is that goes on for people that they're like just not even willing to talk to someone like yourself?
I think they can sometimes see insurance people in the pure sense as grim reapers, because when we come in and talk to people, it is about death. It is about the doom and the gloom.
All the bad stuff.
All the bad stuff. But the positive things would be to say, turn to your spouse and say, I'm covering you and you're covering me. In the event of something tragic and unforeseen occurring, you won't be left out of pocket.
And the scary thing is, we know from statistics that 1 in 3 of us gets cancer, and that's a very shocking statistic for people to even be aware of. But just in terms of other insurances that people need to consider, what other insurances are there that we should look at?
The main thing to look at would be, how do I protect my income? Now, in a jargon term, it's called income protection. Okay. But if you think of it differently, how do I protect my income? Your income can be lost in a number of different ways. The ultimate loss is obviously in the event of death. Sure. You obviously are permanently losing your income. So how do you cover your income in the event of death? Well, that's where the life cover will actually come into play. In the event of loss of earnings through ill health, That's where a serious illness policy could come into play, or what's called permanent health insurance.
What is that exactly?
Permanent health insurance is designed to kick in when you're out of work for a set period of time and your employer stops paying you or perhaps doesn't pay you at all. And it will pay you for a period of time that you either recover, return to work, retire, or pass away.
Okay.
So you can see it covers a number of areas in which there's either no comeback at all, or you do actually return to work.
Do you think it's a useful insurance for people to have?
It is expensive, but
Okay.
it probably is the most comprehensive insurance that's out there relating to loss of income. It won't cover redundancy.
Okay.
So if you do feel that there's a redundancy cloud hanging over either you or your job, there's other areas to look at, which are obviously expensive. But mortgage repayment protection, for example, might be an area to look at. Certainly looking at your savings a little bit closely, and trimming fat on your daily, weekly, monthly household bills and expenses.
And do you find that people are trying to save money and not actually realise that by saving money, putting money aside into a bank account, that they're still leaving themselves vulnerable to not having their insurances paid for or covered or kept up to date, so that if God forbid anything did happen, their savings wouldn't last all that long necessarily. So
Yeah, you'd certainly have to look at the household income, and you then compare the household income to, well, what you actually have saved throughout that year. Where does the money go? When you do start looking on a micro level as to what people spend their money on, it can become a little bit scary. But refocusing your energy, refocusing the mind, can make people an awful lot more aware, and it'll allow them to take responsibility for their finances and be accountable as well. In the event of something going wrong, they've no one else to blame.
would you think that people should take more responsibility for their finances than they currently are in general, or are people okay in terms of how they manage money?
I would say no. I would say they need to look more closely at their day-to-day banking.
Okay.
There might be a number of credit cards in the household expenses. There are a number of different laser cards. Their account, what they call in America, their checking account, which is just a standard current account, might be earning interest of 0.01%. Is there other ways to make your money work for you? So looking at special savings accounts, even if you're squirreling €50 per month away, that'll add up. And if you don't feel that €50 is a burden, then after 10, 15 years, you might have something that will help relating to college fees or relate to boosting a pension payment. So just because things are far way off or a number of years down the road doesn't mean that the action can't take place now to actually sort that out in the long term.
And you mentioned the word pension. What exactly is a pension, and should people invest in pensions?
It's imperative that they understand that a pension itself is simply a manner of funding for your retirement.
Okay.
In the event of your retirement, if you're solely reliant on the state pension, can you actually say to yourself now that you could live on €200 approximately per week? Now, if that's something you can manage on, then I would say, well, you probably don't need a pension.
Okay.
But I don't think many people out there would say they could do that. Bear in mind, when you do retire, your mortgage should be cleared. Most of the banks will state that your mortgage should be cleared prior to 65 or now 70 years of age. People will be working longer in the days to come. But certainly funding for the pension now, it's a priority, I believe. If you're anywhere between 25 plus years of age, you should certainly be looking at a pension fund. Irrespective of what the economic climate is like now, knowing what you can have, looking into it now, and even if you can't afford it now, look at your options so that when certainly the good days might return, you might find yourself on a higher income or a better paid job, you can then make the move towards actually funding for your retirement.
Okay, I'm going to ask you one last question. It's kind of a strange question to ask you, but if you had, say, $10,000 or $20,000 or euros to invest in something, what would you invest that money in that would give the best and safest return? How do people make those decisions?
Sure. You've got obviously low risk, medium risk and high risk.
Okay.
Now, the high risk would obviously mean that the fund, for example, or something you were going to invest in, could be so volatile that you could lose the majority, if not all, of your actual investment. I would always say you should if you're looking to invest €20,000, it's not a huge amount of money to actually play with relating to investment strategies that are out there at the moment. And €20,000 is therefore a lot for someone to lose in one fell swoop. I would take the slow, steady, safe option and look at a bond, for example.
What's a bond?
Well, a bond is an area to secure your finance long term.
Okay.
So you could take maybe a 3 or a 4 year or a 5 year option. Your money is then tied up for that period of time.
It's invested somewhere?
It's invested in a market strategy.
Okay.
You would be going to an investment firm, or some of the insurance firms actually have investment strategies, and you'd be literally saying to a fund manager or a wealth manager, here's my money, go and invest it wisely.
Okay.
It is imperative that whoever you are actually investing with, you can see their fund fact sheet, you can see how their funds have been performing over a 5, 10, 15 year period, and you're happy with how the money is invested. It's not an area to dip your toe in the market. You should be completely happy with how the fund has been presented to you and sold to you. And you need to be satisfied that if there's a capital risk, that it's minimized. So, for example, you would ideally want 100% capital guaranteed, but bear in mind, with 100% capital guarantee, you don't really have the high risk strategy, which will give a maximum return.
Okay.
So with a low risk strategy,
Sure.
you obviously keep your money safer for longer.
Okay. And one last question, and it's probably a question that most couples would like me to ask you. What's the one bit of advice that most couples watching this program should take on board to help them have less conflict when it comes to dealing with money?
Talk.
Talk.
Simply talk. You can do more damage financially in a relationship by thinking that the spouse or your partner doesn't understand where you're coming from, relating to your job, relating to how your job pays you or not pays you in the event of loss of income. Just to simply talk, and then if you've something to worry about, you're worrying about it together and collectively. And two minds are obviously better than one, as they say.
Okay.
Have regular chats about your finances. Sit down over a cup of tea, coffee, glass of wine, with a pen and paper and a calculator, and work things out.
Work things out. Noel, thank you so much. It's been absolutely fascinating and very informative. Much appreciated for your advice today.
No problem.
Thank you.
Appreciate it.